Kia ora, and welcome to the CoreLogic Property Market Update for Whiringa Rangi 2021. The impact of the Delta outbreak is starting to show through in the rate of property value growth now. We have previously noted the impact of the lockdown on the reduced number of properties listed for sale, and this, combined with seemingly unabated demand for property, has translated to extra upwards pressure on values. Demand has continued, as confidence in the market holds firm. While expectations are for slower growth in the near future, an outright downturn seems unlikely, especially without an unexpected external shock hitting the economy and labour market. Indeed, the unemployment rate is currently at a rock bottom 3.4%. Therefore, the long-term attractiveness of the property market remains. And with the promise of borrowing becoming more difficult over the coming months, we may have even seen a temporary lift in the level of desperation for some buyers. Increasing interest rates, tightening lending standards, and discussion on the implementation of debt-to-income caps in late 2022 may have led to some buyers getting in while they still can. After the monthly rate of property growth had slowed for 5 months in a row to 1.4% at the end of September, property values increased by 2.1% over October. This acceleration was relatively consistent across each of our 6 main centres, except for Kirikiriroa, where value growth has been quite volatile. A drop of negative 2.8% in August was followed by a 5.2% lift in September, a level which was always unlikely to be sustained. The 3.7% growth in October is still a very strong figure, even if it is lower than September. One thing this volatility can indicate is a changing market. Previously, any and all listed properties were achieving exceptional sales performance, whereas now, not all properties are selling quite as well as they were 12 months ago. We're seeing some of the same volatility outside our main centres too. Values in Ngā Motu fell by negative 1.6% over October, after increasing by 2.8% the prior month. Meanwhile, Turanga Nui a Kiwa did the opposite, increasing by 3.6% in October after values fell by negative 0.7% through September. In Whanganui, where values are up almost 40% in the last year, the quarterly rate of growth has slowed to 1.5%, the slowest of any of our main urban areas, and a potential sign that the property market has run out of steam. As we edge towards the Kirihimete and New Year break, things will become more difficult for would-be buyers. Fewer owner-occupiers can now access the market with less than a 20% deposit, while investors require a 40% deposit and cannot deduct interest costs from their tax return, unless of course they've purchased a new property. And all buyers are facing further stretched affordability off the back of such strong value growth, 28.8% in the last year. Add in the likelihood of the official cash rate increasing by at least 0.25% this year to fight strong inflation in a resilient economy and tight labour market, and it's clear that borrowing power has and will continue to reduce. That supports our expectation that sales volumes and value growth will both ease considerably in 2022. It's also worth noting that listings are starting to lift, albeit slowly. They're coming off a very low base though, which is why we're unlikely to see a dramatic drop in property values. Of course, the other thing adding to supply are newly built properties. These are heavily incentivised from a funding and tax perspective. But in a capacity-constrained industry, the record level of consents being processed and/or those being complete will top out soon. Considerations for continually increasing costs must also be accounted for, with the latest Goodall Construction Cost Index reporting 5.5% annual growth to the end of the September quarter. The mix of buyers will be of particular interest across the market. As they tend to do, first home buyers have continued to find a way in. Our latest FHB report showed that a record 26.4% of sales went to FHBs in the 3 months to the end of September. KiwiSaver, the bank of mum and dad, and a willingness to compromise on property type and/or location were all factors helping to increase their share of sales. Those things won't necessarily become absent for FHBs, but how they deal with the aforementioned increasing interest rates, yet higher prices, and tightening credit will be of particular interest over the next few months. Unfortunately, for those would-be first-home buyers, desperately trying to save a deposit, the rents they're paying in the meantime have also started to increase at a faster pace. To stay across all these developments, make sure you subscribe to our weekly New Zealand Property Market podcast and regularly check out the research tab at corelogic.co.nz. Our latest reports are all free to download, including the FHB, CCCI and Pain and Gain reports for Q3. Mā te wā.